Okay, welcome back to day 24. And today we'll be discussing extensively in continuation with what we started yesterday, which is on impairment of financial assets, especially those that are carried at amortized cost, and those that may have been carried at fair value to other comprehensive income. Now, yesterday we demonstrated our understanding of impairment with basic principle, where we discussed about the basic understanding of impairment. And in our discussion yesterday, if I'm to share the initial slide, and the initial slide was on this, okay? Trying to explain to us what impairment is all about. Okay, we started by identifying what are the key attributes of IFRS 9 impairment. And we said, first is the adoption of ECL model, the expected credit loss model. And we said the model is forward-looking. And we also conclude that in line with IFRS 9, there are two approaches to which impairment assessment can be carried out. One is a general approach, which is a three-stage model. And the second one is a simplified approach, which is by way of provision matrix, mainly. And we talked about impairment assessment, which is required to be carried out often, or at least once every year. And usually, impairment assessment is carried out at the end of the year. And we also went further to explain the general approach. Okay, we said the general approach could more or less produce a 12-month expected credit loss, and it could also produce a lifetime expected credit loss. And we're going to discuss when do we make use of 12-month expected and when do we make use of lifetime expected credit loss. But to answer to or to have a better understanding of what is expected credit loss, we went further to discuss on what is credit loss. And we also went further to say, okay, if you understand what credit loss is, how do you convert credit losses by way of looking at different state of nature or scenarios to produce expected value of such amount of credit loss? And that's how we're able to obtain our expected credit loss. And we also tend to establish relationship between 12 months and lifetime expected credit loss. And we look at scenarios that more or less expose us to what credit loss is, even though our conclusion of credit loss is that it is the expected shortfall in our contractual cash flows, be the difference between the contractual cash flow and the amount that is certain to be collectible from that financial assets. Any shortfall arising from it is what we call credit loss. And we said expected credit loss is where you consider various degrees of scenarios such that you obtain the weighted average of credit losses with respect to risk of defaulting occurring at different weights. And we also look at that as a scenario. And we now came to a conclusion that the in-depth analysis of expected credit loss requires 4 variables. 3 of those variables are key variables or fundamental variables, while one is more or less like just accounting for the time value of money. Now, the 3 key variables are the PD, which stands for probability of default, which is more or less the possible outcome over total outcome. Okay, there are different models to obtaining probability of default, especially when it comes to conditional probability. Okay, and the second one is LGD, which means the loss given default. The loss given default is obtainable by the difference between 1 and the recovery rate. What is recovery rate? The recovery rate is based on historical data that at a point where we are able to recover upon default certain amount of debt, okay, or certain amount of contractual cash flow arising from the financial assets. And what we're able to recover probably is 40%. It then means that loss given default will be 60%. Okay, We also talked about exposure at default. Exposure at default, you can view from two perspectives. And you see the relevance of those two perspectives when we get to the three-stage model. The first perspective is that our exposure at default may approximate the gross carrying amount of financial asset at default. And the second perspective is that it may approximate the net carrying amount. And as you all know, the difference between the gross carrying amount and the net carrying amount is the cumulative impairment losses that has been created by way of allowances for credit loss on that financial asset from its inception. Now, the last variable, which is key as a parameter, is the time value of money, which tends to introduce the principle of discounting. Okay, and that is what we consider. And that is what gave us this equation, which we'll now try to explain. And what this equation means is that expected credit loss is the sum of the weighted average position of credit losses, having considered probability of default, loss given default, and your exposure of default by discounting to reflect the time value of money. Okay, and we demonstrate understanding at that point with what I'm going to share now with the Excel. And in the Excel, we pick an illustration that gives us exposure over that. And that illustration is what is on the screen. And that produces what we have here with respect to expected credit losses at a simple basis. Okay, and I think that's where we stopped yesterday. And today we'll be going into more discussion or elaborate discussion on it before we now come back to provision matrix. Okay. Any question or any contribution before we proceed on our in-depth discussion today? Over to you guys.
Okay, meanwhile, good afternoon. Hello?
Afternoon.
Okay,
afternoon.
So what I just want to say is that the calculation that you did yesterday, I didn't really get it, and I do it for two major reasons, which is number one, I'm using my phone, so the Excel whatever I was not really following, but I tend to download watch the video and then download the Excel sheet and catch up on that.
Okay.
I hope it doesn't actually affect what I'm going to learn next. That is just what I want to say.
Okay. Thank you for understanding what you do. Now, going forward, I'll advise you that you must always have your laptop. Okay, because you can't more or less appreciate Excel with your phone. Okay, if you use Excel on your phone, it's just for you to view, and it might be difficult for you to use formulas. Okay, but what you do is, what I would advise is what you have already decided to do, which means you need to download the video, and also you already have the Excel file, and you have the practice question. Therefore, once you watch the video, you can more or less relate the video to your Excel file. And on the Excel file, you can be able to click on each of those cells to see how those things were linked. Okay. Thank you very much. Any other contribution?
Good afternoon, everybody.
Afternoon.
Actually, I was in the classes today, and I really appreciate the step-by-step approach you adopted to explain the expected credit loss model. Unfortunately, I think I will still need to listen to the video once again in order to get in-depth knowledge of what the expected credit loss model actually entails. But I want to ask, based on the provision of IAS 39, I think it's basically talk about incurred loss model, right? Are we still going to get to where how Ecl loss model is always calculated or adopted?
Okay, the first question is, why do you need Ecl loss model when it is no longer in use? I-39 is no longer relevant for us.
Okay.
IFRS 9
I think for
superseded.
knowledge.
No, there's no knowledge of backward. If you want to have knowledge of backward, you go and do that research. You know, remember, knowledge is for use in future. If you are looking at something that is no longer in use, it's like saying you want to learn the knowledge of how video, what's it called? You know, the video cassettes is being used. It's no longer, the knowledge now is what will be used today, tomorrow, and in the future. Okay?
Okay,
But
what really differentiates the incurred loss model from expected loss model?
Yeah, I think I've explained that, but what differentiates them is very simple. Incurred loss means that you don't anticipate what the loss will be until there are loss events that triggers your assessment. But this one is saying that immediately you have any financial assets, especially those that are carried at amortized cost, from day one, you are already making allowance for credit losses. Okay. That's why we said it is forward-looking. And secondly, this one consider more microeconomic variable, which means you don't subject asset to impairment on a standalone basis. Because yes, that asset might be performing on a standalone, but there are microeconomic objective variables that affect it in the long run. So that if Nigeria economy continues to go down and we run into a hyperinflationary economy, a particular financial asset, no matter how strong it is, will be affected, which might create a default. And therefore, that is why expected credit loss model does not only look at information unique to a financial asset, but it also looks at information from the macro basis that may affect the financial asset. And if I will advise you to go back and watch again, and also listen to the videos we played in the course of program to hear various macroeconomic variables that are inputted. But one thing also is this, that the question is, to what extent do you incorporate macroeconomic variables? The standard did not give that guidance. That's why the standard did not even tell you the extent. But what the standard only identifies is that most companies have internal model. And as time passes, your internal model becomes more robust. But one thing that must be common to every internal model is that you factor in, to a degree, microeconomic variables that may affect your financial assets. And that is a position of the standard. Is that okay?
Sorry, is very okay. Can you share the video we watched yesterday on our maybe
no, you can't share it because it's heavy. You can't share it. It's heavy. Except if I have the link. I can get the link, but it's heavy. But again, once you download our lecture yesterday, you already have the video automatically.
Exactly. Okay, thank you.
Okay, now let's start our journey. Our journey is to discuss extensively the general approach. Now, as I've said earlier, the of the general approach is where all financial assets are categorized. Every financial asset at origination are automatically defaulted in stage 1, except for credit impaired financial assets at initial recognition. I repeat again, every financial asset that will be subjected to impairment assessment are all in stage 1 at the point you became a party to that financial asset. The only exception to that rule is for credit impaired financial assets at origination. The question then is, what is credit impaired financial assets at origination? A credit impaired financial asset at origination is synonymous with financial assets that was already in default prior to you acquiring such financial assets. You ask me a simple question. How possible can you acquire a financial asset that's already in default? I'll give you an example. How many of us know about AMCOM in Nigeria? How many of us know about AMCOM in Nigeria? Who can tell me a little bit about AMCOM?
Okay, good afternoon. So I was AMCOM. I think what I know about is that it's asset management company of Nigeria, and it's also there. What it does is that tend to bankrupt. It tends to they buy the asset and liability of those companies, and I think those are things. What they do? They manage it and stabilize it, and to the ability of those companies. I think the essence of it is just to make sure that stakeholders, especially those who are old or bondholders or whatever, they are not the economy will not be in serious jeopardy. That is my little understanding of AMCOM.
Okay, I don't want to go to much more of the module operandi or the objective of creating AMCOM, but I'll just simplify it to say AMCOM, as you have said, in full name is known as Asset Management Company of Nigeria, and it was set up by CBN in 2011. And AMCOM is known as a bad bank. In the international financial service space, a bad bank is a specialized bank that buys delinquent loans, buys delinquent debts in order to revive them, which means the specialty is to buy toxic assets and bring them up to speed, because that is the specialty they have. Therefore, every loan acquired by AMCOM is not a good loan, it's a bad loan. And such loans that are bad at origination by way of purchase by AMCOM are known as credit impaired financial assets at initiation. I repeat, credit impaired financial asset at initiation. Now, let me give you the IFRS 9 definition of it. IFRS 9 defines it as thus. It says, a credit impaired financial asset is a financial asset when one or more events has occurred that have a detrimental impact on the estimated future cash flow of that financial asset. Now, if you purchase such an asset at origination, it is considered purchased or originated credit impaired financial asset, which I earlier called credit impaired financial asset at origination. And such assets are purchased or originated financial assets that are credit impaired on initial recognition. And I don't think there's a better example to that of AMCOM, which means if you find yourself in a situation where you buy a bad debt, also, buying a bad debt is also known to factoring of debt. A factoring agent usually buy bad debts, or an invoice discounting agent usually buy bad debts. But instead of loan, those ones are receivables. They are also considered as purchased or originated credit impaired financial assets, which are credit impaired financial assets on initial recognition. Now, remember where we are coming from. I said stage one belongs to every financial asset at origination, except for those that are purchased or originated credit impaired financial assets. Now, stage 2 represents when you start to experience significant deterioration in credit quality. What does that mean? When a financial asset has started to experience difficulties in meeting up with the contractual cash flows. Therefore, we will consider such financial asset to have suffered credit events that has more or less significantly deteriorated over time. Stage 3 is the last stage to which any financial asset can belong. And financial assets are in stage 3 when they are credit default. What it means is that they are credit default assets or assets that are already in intense difficulties such that the recoverability of their cash flow might be much more difficult, which means they are credit default by nature. And that is the worst scenario that could ever happen to a financial asset. Now, what is the implication of being in either of these stages? The implication is grouped under these 3 questions. Now, the first question I'm going to ask you is, when and how is impairment recognized? What does that mean? It means at initial recognition is where you belong to stage 1. And even from day 1, you're already accounting for impairment losses as an allowance for credit losses, even when nothing has happened. Because remember, it is not incurred loss. It is not until loss event. You are saying that every loan has a propensity to default, has a probability to default, no matter the condition of that person. Because remember, not only that person's condition matters. What about microeconomic objective? What about international issues? See pandemic. Do you understand that? Therefore, it is not just about your ability alone or your capacity alone. It goes beyond that. And that is why the degree that every financial asset has a propensity to default is taken into consideration. That is why, with or without evidence of default, you subject all financial assets upon initial recognition to an assessment, which could give an allowance. Though your impairment assessment might be 0, but it is a value, other than not testing it for what? Impairment. Okay, that is that for stage 1. You can only go to stage 2 when you start to experience difficulties from stage 1, where you experience what we call a deterioration in credit risk. And this deterioration is considered to more or less becoming critical or becoming significant to you, which means when your credit risk start to increase astronomically or abnormally or significantly, such depict that you belong to stage 2. Now, there are qualitative things that you can consider. But the first thing we consider is the threshold, quantitative. Though it is rebootable, though it is presumptive in nature, but evidence has shown, which has formed the basis to which the standard conclusion was based, that it is more likely that when a financial asset is having difficulty to meet up with the contractual cash flow after more than 30 days, in which interest is not paid, or principal is not paid, or interest and principal is not paid, after 30 days, it's much more visible that it has experienced a significant deterioration in credit risk. But the word rebootable means that the nature of a company business, the nature of its industry, the nature of the economy might vary that 30 days, which means it could be more than 30 days in your own case, but you must be able to justify it, and it can be less than 30 days in your own case. But on the average, once there's a deterioration for more than 30 days, inability to meet contractual cash flow in part or in full will be considered of a significant deterioration in credit risk. Therefore, you belong to stage 2. You belong to stage 3 when there's an objective evidence that there's a credit loss event. What does that mean? And I'm going to show you. There's a credit loss event when you are already in default, or what I will call perpetual default. Rebootably, any debt, receivables, loans that cannot repay itself or that cannot pay its interest or principal or both after more than 90 days is sufficient to say this is credit impaired. And in that case, it belongs to stage 3. But it goes beyond just the quantitative. There are factors we need to consider. There are situations we need to consider. There are triggers we need to observe. And what are they? The following may be considered as an evidence of loss events or credit defaults. Now let's look at them. One is when the issuer of such a financial asset has started to experience significant financial difficulties. It shows that such financial asset may be credit impaired. When the issuer has started to breach contracts so that it starts to default in interest and or principal, in part or in full, so that the lender is now granting a concession to the borrower that it won't have granted in a normal day, but is granting it in a bid to revive its recoverability of its contractual cash flow collection. A situation that becomes probable that the borrower will enter bankruptcy or will be declared bankrupt. When you start to see a financial asset that is listed in the market and has lost its activeness in trading, its liquidity has been eroded, and its active market suddenly start to disappear, that also proves such evidence. And finally, which is not limited to all this because it's not exhaustive, when the purchase or origination of financial asset is such that it is purchased at a deep discount that reflects much more of increase in its credit losses, such also is a trigger that there's a loss event. Any of these or combination of these or others is sufficient enough to conclude, regardless of considering the threshold, that such a financial asset is credit impaired, and therefore it belongs to stage 3. Now let me shock you here. Stage 1, 2, 3 are not necessarily transitory. I repeat, stage 1, 2, and 3 are not necessarily transitory. What does that mean? It means that it is not that you graduate necessarily from stage 1 to stage 2 and graduate from stage 2 to stage 3. No. From stage 1, you can end up in stage 3 without branching to stage 2. And scenario might come that from stage 1, you go to stage 2. And as matter moves on, you go to stage 3. Or you just stay in stage 2 all through the remaining life. And the beauty of it is that also the dry bone can rise again, so that a financial asset that has moved from stage 1 to 2 or to 3 may reverse its position when it has had an improved market and financial condition. And therefore, you can return back from stage 3 to 2, or stage 3 to 1, or stage 3 to 2, and subsequently from 2 to what? To 1. Take note, entry point for all financial assets is stage 1, except for those that are purchased or originated credit financial assets at initial recognition. Now, the second question is this: how is credit losses recognized? Remember, I discussed about the two expected credit losses that can be obtained under general approach. The first one is 12 months. The second one is lifetime. Now, stage one, you only make use of 12-month expected credit loss. I will come back to 12-month expected credit loss as a portion of the lifetime. While the lifetime, consider all possible scenarios over the remaining useful life or remaining life of that financial assets. But when you get to stage 2 and stage 3, they have things in common with respect to recognition of expected losses. Both recognizes losses based on lifetime of the financial assets. Stage 3 also is lifetime expected credit losses. Finally, the effective interest rate, how do we calculate it? And the effective interest rate, on what do we recognize it? Is it on the carrying amount, which is the gross carrying amount, or on the net carrying amount? Now, effective interest rate is the original effective interest rate, which means it does not change, except if there is a significant modification to a financial asset. But if there's no significant modification to a financial asset, your effective interest rate that you use over the life of the asset is the same effective interest rate that was obtained at the initial recognition. And you understand how we derive that. Okay, but in the recognition of interest income as the lender or as the owner of the financial assets, or as who has a right over the financial asset, you will be determining your interest income both for stage 1 and stage 2 using effective interest rate on the gross carrying amount. And I've said earlier, the gross carrying amount is the carrying amount of financial assets majorly at amortized cost without giving consideration for the allowance for credit losses. That is, without deducting allowance for credit losses. But stage 3 requires computation of interest or measurement of interest income on the net carrying amount. And the net carrying amount is the gross carrying amount after deducting all allowances for credit losses. And that only applies to stage 3, because at stage 3 level, you are fighting for recovery. You are not even fighting for continuation of interest, because it's the survivor of the fittest. You survive first. You even survey your capital, talk less of saying there's interest you want to mandate for collection. And that is the position with respect to general approach, which means the impairment assessment we are talking about here is what? General approach. Any question? Any question at this point? Now let's look at 12 months. What is 12 months expected credit loss and what is lifetime? Now, if we look at lifetime expected credit loss is the expected credit loss that results from all possible default events over the expected life of the financial instrument. When you go back to what we did yesterday, this is a lifetime because there was a delinquency in the loan. okay, where it's already in default because bankruptcy has been declared. And that is why we look at the shortfall over the remaining 3 years of the bond. And that is an example of lifetime. Any question? Any question?
None from my end.
Really? You too? Yeah.
None from my end.
Hello, sir.
Yes, sir.
Yeah, I think by the time we have opportunity to run through the model and the exercises, we will be able to know if there is one way or the other we can ask questions. But for now, there is no question.
Okay, if there's no question, let's go back to our presentation slide. Now, I show you something. The input to determine the general approach or the input generally to impairment modeling is that you must be able to provide fundamental supportable data or information to obtaining the expected credit loss value. And what do? You consider these 3 things first. That the financial statement should reflect the general pattern of deterioration or improvement in the credit quality of financial instrument within the scope of the model. Secondly, IFRS requires entity to base their measurement of expected credit losses on reasonable and supportable information that is available without undue cost or effort. And this is where it comes in to say a small bank, a trader, a trading company will not go for a subscription model so that the benefit of that model outweigh the cost. Also, the cost outweigh the benefits. All the receivables you want to test for impairment are no more than 10 million. And you now want to engage a model that a consultant will develop and collect 2 million there. The question is there any collected, because of accounting, 20% of the value of the receivable is gone for payments. You can say that, which means you build the model. That's why IFRS support more of internal models. And when you watch all the video we discussed yesterday, you do it at your own macro level. You can say now, you don't go and do subscription model that GTV will do as a microfinance bank that is capital base is not more than 50 million. Whereas GTV alone will spend like 50 million for running impairment model, the whole of your own capital. Do you get what I'm saying now? And that is that. You develop it based on reasonable and supportable information without what it becomes as onerous on you. And the key things you look out for are historical information, your current data, and your future expectation, which is like your forecast. Remember, it is forward-looking. Furthermore, expected credit loss are updated at each reporting date, which is the reason why I told you that impairment assessment is done at least once every year, even though you can do it more frequently. But at least if you are doing it once a year, it must be at the end of your reporting period. And you must use that to reflect or update for new information and changes in your expectation, even if there has not been any significant increase in credit risk. Because your estimate must reflect current information and future expectation. Now, as I told you earlier, upon initial recognition of financial assets, you compulsorily must recognize an allowance for credit loss for at least a 12-month expected credit loss. Why? Because that belongs to stage 1. The only exception to that is for purchased or originated credit impaired financial assets, which comes in by way of stage 3 upon initial recognition. Okay. Now, as I said earlier, which I've shown you yesterday, to derive our expected loss, it is calculated by multiplying the probability of default occurring in the next 12 months by the total lifetime expected credit loss that will result from that default. This is not the same thing as expected cash flows over the next 12 months. Okay, remember we demonstrated that yesterday. Okay, finally, the intention is that the amount recognized upon initial recognition acts as a proxy for the initial expectation of credit losses that are factored in the pricing of the financial assets, which do not represent an economic loss to an entity because they are expected when pricing the instrument. And that's why also pricing of instrument plays a role in the assessment of financial instruments for impairment upon initial recognition as stage 1. As I've told you earlier, issue of 30 days past due is rebootable to consider it to have increased significantly the amount of credit risk. But again, internal credit policy also plays a role based on your historical performances. Okay, financial instruments with low credit risk. Certain financial instruments have a low credit risk and would not therefore meet the lifetime expected credit loss criteria. Entities then do not recognize lifetime expected credit losses for financial instruments that are equivalent to investment grade, which means that those kind of assets has low risk of defaults. Okay, subsequent recognition of financial instruments is subject to either increase or decrease in the credit risk since inception. Okay, and that will determine when impairment assessment is done based on lifetime. And at stage 2 and stage 3, impairment assessment will be done on lifetime, as opposed to stage 1 that is done on 12 months. Okay. Now, how do we treat impairment losses? Impairment losses are to be charged to profit or loss. Okay, are to be charged to profit or loss, and it will be charged to reduce directly the financial assets. Rather, an allowance account will be created, which will be mapped with the financial asset in order to reduce the amount of that financial asset at the reporting stage in the financial statement, which means impairment losses are not necessarily bad debts. Therefore, they are just an allowance. They are just like provision, which you are making against a financial asset. And therefore, you create that in an allowance account separately from the financial asset. And for reporting purposes, you link them together in order to reduce the financial asset from its carrying amount to what is recoverable. Thereafter, adjustment of loss allowance. Entity must then recognize the profit or loss, any impairment gain or loss. Impairment gain is where originally recognized impairment loss has now been reversed because of improvement in credit quality. Okay, and the amount of expected credit losses or its reversal that is required to adjust the loss allowance at reporting date to the amount that is required must always be done in line with Ifrs 9. As I have said earlier, for a purchased or originated credit impaired financial assets, Ifrs 9 requires that such a financial asset that is credit impaired at initial recognition must be treated differently because such an asset is credit impaired at initial recognition. Now, for this asset, An entity must recognize changes in lifetime expected credit losses since inception of such when an allowance was created at the point of origination. And such will be recorded or reported in your profit or loss. Okay, under this requirement, where there are any favorable changes, such that an asset has an impairment gain, such a gain will have resulted from an improved cash flow arising from that financial asset, and such will also be recognized as it occurs in your profit or loss. Now, again, what I discussed with you yesterday, which I brought a formula to, okay, is that when we are computing impairment assessment with respect to expected cash flow, there are key variables that are key. The variable to obtain your expected value are the probability weighted outcome. And the probability weighted outcome is scenario based, which can come from best case scenario, worst case scenario, base case scenario, or by way of state of nature, most likely, most pessimistic, most optimistic, and different state of nature. But you always reflect the possibility that a credit loss will occur, and that possibility that it will not occur, which means that's why you factor probability. Probability is a chance of occurrence of an event out of all possible chances or possible outcomes. Now, you always consider the effect of time value of money, which require you to discount all your future cash flows, whether by way of shortfall or otherwise, from the future back to your reporting date, which represents your today. And you need reasonable and supportable data and information as an input to your model. And that's why your data and information must be a combination of historical data, your current data, and your future expectation or your forecast. And that is very key and paramount to such an assessment. Okay, that is that. Any question before we move on? Any question before we move on? Madam Grace, I've now heard your voice today. What is your contribution? And any question for us to further ahead? Madam Grace, we can't hear you.
Good afternoon, sir.
Afternoon, ma'am.
You've not heard my voice since yesterday. I see.
You didn't join us yesterday. Why, ma'am?
Yes, sir. So I think I just have to create time to listen to this during the week so that just bear with me. By next week, I think I should have, if there's any question, I will ask.
Okay. Any other contribution? And now, and Nuruddin?
No contribution now. No question now. Just follow it. We may have question later. I may have question later on. But for now, no.
Okay. Now we'll go to the provision matrix, where we use a practical expedience. Okay, this diagram only shows how you move from stage 1 to 2, from 2 to 3, or otherwise. Okay. Okay, let's look at provisional matrix. Now, remember we discussed the simplified approach. Now, the simplified approach is, the standard identified that your model should be a reflection of your level of sophistication and such that you only make use of reasonable and supportable information that is not onerous to your operation, which means that such information should be information you can easily access, not the one that will cost you more in a nature that the cost of it outweigh the benefit. And that's why the standard provided a simplified approach for simple financial instruments and for those that may not have the capability to easily search for information or develop a robust model that can address the sophistication of carrying out impairment assessment. Remember, the output of the impairment assessment is also not exact, it's just a mere estimate. And that's why as time goes on, you improve on those models and try to get it right at every point in time. Therefore, it is not what to kill yourself on. In order not to kill yourself, that's why we have the simplified approach. And what does the simplified approach do? It assists you to simplify the process of obtaining your expected credit loss. Again, the simplified approach is commonly used for financial assets that are not interest-bearing. Okay, what are financial assets that are not interest-bearing? Examples are trade receivables, okay, without financing elements, like lease receivables without financing elements. Okay, all of those is what we can make use of simplified approach by way of provision matrix. Okay, and it is adopted only for when it is practically expedient to do so. And that is the position as at that point in time. Okay, and now we are going to demonstrate it practically. How do we make use of this model? Okay, what I'll do first is that I will allow somebody to read the question and you guys will discuss it preliminarily as a group before I prefer suggested way of actualizing our goal. Okay, what we are going to do is I'll share this question with you on Excel and thereafter we'll model the answer. I want somebody to read this first.
Okay, let me read it. Is it the questions that okay? Trade receivable information as at the reporting date.
And what is the reporting date? You can see the reporting date on the side here.
Okay, 31st December 2019.
Yes. Continue from there.
Okay, so grouping, invoice dates. So we have about 4 columns. Is it columns or 4 rows?
Call the heading of those columns because it has significance.
Okay. Grouping, invoice dates, invoice amount, and outstanding balances on those columns. Then under grouping, we have group A to E. So I'll take under group A, we have 1st March, that is invoice date, 1st March 2019, invoice amount on that date is 1 million. Then outstanding balance on that date is 1.
As at what date is that outstanding balance?
Okay, that is 31st December 2019.
Yes, that means
Yeah, that's yes.
invoice of May, you are only able to get like 880,000. Why 120,000 is outstanding?
Outstanding. Okay, yeah.
Okay, that's what it means. Continue.
Oh, okay. So on the 4th of May, invoice amount 800,000, but as at the reporting date, 31st December 2019, outstanding balance is 100,000. So invoice on 10th September 2019 was 500,000. As at the reporting date is 200,000 outstanding balance. The invoice on 26th November 2019 is 1.2 million. Then as at the reporting date, there was an outstanding balance of 320,000. The invoice on the 10th of December 2019 was 600,000 with an outstanding balance of 450,000 as at the reporting date. So we now have another table. That table, okay. I don't understand this one. There is percentage, 2%, 3%. Is that table important?
I read what is it? They gave you loss rates.
Okay, the table we have loss rates.
They gave you loss rates.
Pardon? Hello?
Yes.
Okay, let me just
They gave you loss rates.
Yeah, just rates, yes. Rates for current is 0%, 1 to 30 days, 2%. That is the loss rate. 31 to 60 days, 5%. 61 to 90 days, 10%. Above 90 days, 40%. Then there is an asterisk. Okay, there's an asterisk that says that there's a note that says allowance for credit loss as at 31st December 2018 is 124,000. Required. What is the amount? What is the amount of allowance? What is the amount of allowance for credit losses under IFRS 9 under the Simplified Approach with the aid of a provision matrix? B, what amount of impairment losses or gains should be reported in profit or loss for the year ended at the 1st December 2019?
Okay. Before I allow you to discuss within yourself, okay, I'll play this video for you to give you some guidance. Okay. Let me try and play this video for you guys.
Hello, welcome to the next in our series of videos on demystifying IFRS 9 for corporates. I'm Sandra Thompson. I lead our Global Accounting Technical Group for Financial Instruments. I'm here today with Derek Carmichael. Derek's a member of my team and helping our clients as they implement IFRS 9. Last time we talked you through IFRS 9's new impairment requirements. We mentioned these are likely to be quite complicated for corporates to apply, but there are some simplifications within IFRS 9. And one is to use a provisions matrix. Now, we've had lots of questions in practice about how a corporate might actually do a provisions matrix. Because the standard doesn't specify. So what we're going to do today is to walk you through one example of how we think a provisions matrix might actually be operated in practice. Now, there is no prescribed method in the standard, so there are probably other ways you can do it. But we think this is a very practical way, and we hope you'll find this useful. So Derek, can you kick us off with how our company might actually do a provisions matrix?
Sure, Sandra. So just before we look at an example of a provision matrix approach that we think would work, it might be worth starting off with an example of what we think wouldn't work. On the slide, you'll see a relatively simple calculation that a company might have previously performed. What they've done here is they've taken their receivables, analysed it into time buckets, and applied a historical default rate to each of those time buckets to calculate what they're expecting the impairments to be. Now, there's a few problems with this approach that we think it wouldn't work under IFRS 9. First of all, it is only using historical information rather than including forward-looking information. And the second problem being they have used a standard percentage to all of the time buckets, where you would expect that as receivables get older, the probability of them not being paid would increase. Within the approach that they've used here, though, the number that has been calculated is 4.2.
So Derek, this doesn't comply with IFRS 9. Can you walk us through how you might come up with a method that does?
Sure, Sandra. Well, the first step would be to define a period of sales to analyse, to then identify how much of those sales are ultimately written off as bad debts. It's important here to make sure that you're taking a sufficient period of time to provide you with useful information. So too short a period of time would result in information that might not be meaningful, but at the same time you wouldn't want to take too long a period of time, because changes in the marketplace might mean that any analysis that you're doing might no longer be valid. For our example that appears on the slide, we've taken a period of 1 year, and within that period of 1 year we have sales of 10,000, and ultimately bad debts arising on those sales are 300.
Okay, so what would you do next?
So the second step is to calculate a payment profile for these receivables. It's key to work out how much of the receivables are outstanding after each period, up to the point when the bad debt is written off. In this instance, customers paid 2,000 within 30 days of the sale date. Therefore, 8,000 did not pay within 30 days. Customers then paid an additional 3,500 in the next 30 days, and so on until ultimately the remaining receivables which were to be written off was 300. The aging profile calculated in this step is critical for the next step, when we will actually calculate some default rate percentages. Step 3 calculates the historical default rate percentage. What this slide demonstrates is that the receivables have been analysed into individual time buckets. The overall receivables per the example are 10,000. We know that 300 of those receivables are ultimately written off. We take that 300 and apply it to each of the time buckets, because we know that that 300 is included within each of those time buckets. This approach allows us to calculate a default rate percentage for each individual time bucket. However, that's really only the step 3 in the process. This is all based on historical information, and as we know from the IFRS 9 model, forward-looking information does need to now be incorporated. Sandra, could you walk us through how we would do that?
Yes, and I think before I kick off I should say this is likely to be the most difficult and the most judgmental step in the process. And I think the key to adjusting that historical default rate of 3% to something that includes something that's forward-looking is to understand what actually drives the levels of default in your book. So for your kind of customer, what actually causes them not to pay and to go bad? Let's suppose in our example, our company is selling to ordinary retail individuals, and let's suppose it's determined that actually its default rates correlate well with unemployment. That's the main determinant of when people default. Let's also suppose that it's looked at the unemployment data. Unemployment is rising and is expected to continue to do so. It's then said, well, what happened last time when unemployment rose? And it's done some analysis that shows when that happened before, default rates stepped up by about a third. So therefore it's going to take its default rate of 3% and similarly step it up by about a third. Now that 1/3 is a judgmental number, but it's the kind of process you might do under IFRS 9. So now our bad debts have gone up from 300 to 400. We apply that 400 to recalculate all our default rates, and we end up with the numbers shown on the slide. Okay, so having made our default rates forward-looking, Derek, what do we do next?
Well, the final step would be to take those default rates that you've calculated and apply them to the actual receivables at period end. So each of those individual time bucket default rates would be applied to the receivables within each of the time buckets. Taking this approach now results in a revised expected credit loss of 12.
Thank you. And as you can see, that 12 is a lot higher than the 4.2 that we had on our first slide. And that happens for two main reasons. The first is we've made it forward-looking, so we've stepped the default rates up by 1/3. And the second is that when we've age profiled the debtor, we've applied an increasing default rate. We've reflected the fact that as debtors get older, they're more likely not to pay. So just to recap, IFRS 9 has new impairment requirements. They're going to be quite tricky to apply. They're likely to result in bigger, more volatile bad debt provisions. They also require you to include forward-looking information. We stepped you through one simplification that companies can use for trade receivables, a provisions matrix, and we've shown you how that might actually work in practice. Now, as I said at the start, there may well be other ways you can do this, but I think the two key factors to bear in mind is you need to reflect the fact that as debtors get older, they are more likely not to pay, and also to include forward-looking information. Thank you very much for listening, and I hope you'll join us next time. Bye-bye.
Hello and welcome to CFO Tools tutorial on ECL calculation for receivables under the Simplified Approach. In this tutorial, I'll illustrate the basic steps needed to produce your first analysis of a portfolio of receivables. To start the calculation, I will begin by opening the Simplified Approach module. The interface you see shares a common logic with the rest of the CFO Tools modules. The main item of interest is the result of the computation, and that is why the Analysis tab is shown first. The other tabs placed to the right of the Analysis tab cater for the preparation of the various components that fit into the analysis under the Simplified Approach. An analysis is prepared by sequentially working through these tabs from the right to execute the required steps that lead to the final result. The algorithm takes the input data, constructs a loss rate curve based on the historical losses, and applies this curve to the balances to compute expected credit loss. The rightmost tab is the Help tab. It contains the essential information to assist with the use of the system and understand the details of the operations performed in the other tabs. Additionally, contextual information is provided through the interface to guide the user on the type of input expected in specific places. The Historical Data tab is the point where information on past transactions resides in the system. You can inspect and modify the dataset that are already in the tool. You can also create new datasets. The data uploads is done in spreadsheet form as XLSX file. You can save either from Excel or with LibreOffice. The templates specifying the format for invoices and payments data can be downloaded to streamline the data preparation process. To work with an existing dataset, I click its name in the list of datasets and it opens in the current browser window. Datasets are named to help you easily identify them. Once the dataset details have been loaded, we see a summary of the dataset characteristics at the top of the page. These include the dataset's name and creation date, number of invoices, the payments in the dataset, as well as their corresponding time spans. The bottom part of the page hosts tabs that allow us to inspect the individual records in tabular form. In case we need to perform a more thorough inspection of the data, it may be more convenient to download a local copy instead of working inside CFO Tools. This can be done by clicking on the download button below the data tables. The adjacent upload button can be used to upload corrections or additions to the dataset. Upload adds new data to the existing data, but also replaces existing data if invoices with the same numbers are imported. A new dataset is created by clicking the New Dataset button in the main Historical Data tab. I need to name and save the dataset first, and after that I can proceed to upload the corresponding files containing the data. A dataset can be deleted through the Delete button at the bottom of the page. The Ecl Model Tab deals with the estimation of loss rate curves. Each loss rate curve is stored in an Ecl model. The main Ecl Model tab shows the existing Ecl models. It also allows me to create a new model by clicking the New Ecl Model button below the list of existing models. As with datasets, clicking on a particular model in the list opens the details of that model. These include the model name, the dataset that was used to estimate the model, the number of days taken as loss cutoff threshold, the currency of the analysis, and the date of the analysis. If the dataset features invoices and payments in different currencies, then there is also a separate table with the relevant exchange rates needed to convert all invoices amounts and payments to the currency of the analysis. Below these details, we see the computed loss rate curve presented in both graphical and tabular form. Changes to a particular model are made by revising some of the parameters I described and clicking the Save and Calculate button. A notification message will be displayed, and after the calculation is finished, the model result will be updated. A new Ecl model is created in a similar way by specifying the set of required inputs and running the calculation. A model that is no longer needed may be removed from the system by clicking the delete button. The Balances tab holds the data to compute Ecl4. When I click it, a familiar structure is displayed with the balance data that is already in CFO Tools presented in a list and the option to enter new balances by means of New Balance button. Clicking on an entry from the balances list displays the details of the associated balance data. These include the balances dataset name, date of the data preparation, and summary statistics. Below that, we have the table with the individual balance entries and the already familiar buttons, allowing us to upload new or revised data, download a snapshot of the data, download a template to populate with new data, save or delete the dataset. Finally, we have the Analysis tab, which brings together the different elements described so far to compute the expected credit loss for a set of balances. We again have the option to look at already completed analysis or create a new one. If I click on an entry in the analysis list, the components of the analysis will be displayed. These are the name of the analysis, the balance data to calculate Ecl4, the chosen Ecl model to be applied, and the date as of which the analysis should be done. We also have the option to input a correction for a change in macroeconomic conditions between the historical period covered by the Ecl model and the period we are computing Ecl4. We also have a drop-down menu for the currency of the analysis. An analysis for which Ecl has been computed will also have fields for total balances, Ecl in percent and as a total amount, and status of the analysis. Below that, we have the computed losses by invoice in tabular format, followed by buttons allowing the download of the data, saving and calculating the analysis, or deleting it. That is all it takes to do your IFRS 9 Simplified Approach calculations. I hope you enjoyed this video, and thanks for watching.
Okay, I'll give you 5 minutes to have discussion, and thereafter, I'll come back to discuss it extensively and try to provide solutions. Okay, welcome back from your discussion, and I think I had you guys 1 or 2 questions. I want you to ask the questions before we start the solution. Enaro, you raised 1 or 2 valid questions and you make a consideration or conclusion. Awaiting my contribution. Can you repeat that question now?
Okay, so what I was saying is that the loss rate is the historical data is I was asking if that is how the information is generated, the loss rate from historical data. Because definitely it cannot be arbitrary, but it's based on some past information, past knowledge of the past knowledge. That is what. And then my second point I also made was that I think that once we're able to apply the loss rate on the number of days these outstanding balances they have as the sum total, we compare it with the allowance for credit loss of the previous year, and if it is higher, the difference will not be our payment loss. Or if it's lower, the difference will not be our payment gain. Those are the those are 2 things that I said.
Okay, thank you very much. Let me start. The first one is that the loss rate is not arbitrary. It is based on historical data. Historical data of losses, actual losses that were recorded on those receivables. Now, what happened is this. Evidence has shown that based on the grouping, receivables that are standing within certain buckets or certain past due days are non-collectible to this degree. The non-collectability or uncollectability to a certain degree at that bucket is what we use in deriving the loss rates. And what I've done is that I've shared 3 or 4 resources with you, links and documents, which will also give you preference and like give you guidance towards having better appreciation of it. Remember, you can't be an accountant of repute without in-depth research. Accounting finance is not longer on the surface. In-depth research. Don't be shocked, your in-depth research can make you start to develop models for certain organizations. Do you understand? And that is the beauty of it all. Now, how do you derive it? You look at aggregate data over a particular period of time. Probably you look at data for the last 5 years, or for the last 3 years, or for the last 10 years. But take note, the medium to which you get that data should not be what will cost you more than the value you will derive from getting those data. And that's what will influence whether you need to get data as long as possible or not. Secondly, why do you need to get data for 10 years when the economic regime has shifted over 10 years? Thirdly, you continue to update the information with new, as of 2019, we use 5 years, starting from 2015 to 2019. In 2020, we can make it a moving average where we now use 5 years from 2016 to 2020, which means you have more or less taken out 2015 and you have brought in 2020. And at that point in time, you develop a new loss rate. Because remember, your loss rate should be a reflection of 3 things: historical, current, and forward-looking, which means forecasting. And most recent period is much more a better representative of the future than the more backward periods. And that is how you derive it. You ask yourself, of all these receivables, how much were you able to collect and how much were lost as a result of non-collectability of those receivables? We now say, okay, the how much you cannot collect over the total amount of the receivable will give you your loss rate. And that's how loss rate is obtained. This loss rate table will not be exactly the same thing. Which year is this one? 2019. It won't be the same thing for 2020. By the time you do 2020, let me just copy this. By the time we do 2020, let's say this 2020, the rate might have come to 4.5, 10.2, 18.9, and probably 55. You can see now, it's a dynamic rate, it's not static. Who can tell me why current is 0%? Can somebody tell me why current is 0%? Why is current 0%? Who can tell me why? No clue? Okay, let's explain what it is. What is a past due? A past due is a collection of receivables that its credit period has elapsed, and a portion or the owe remain unpaid subsequent to when the credit period elapsed. Let me put it in simple sentence. Somebody bought goods worth 1 million naira from you. You gave 30 days credit period. After the 30 days, he has only barely paid 700,000 out of 1 million. A day after that 30th day, it is already a day past due. What is a day past due? 300,000. 2 weeks after, it becomes 14 days past due. 4 months after, it becomes 4 months past due, which means 4 months after the credit period has elapsed and you have refused to what? To pay. That's what it means. What does current mean? Current means it is not yet past due. Though it's owing me, but it's not yet more or less like in default. No. I gave 30 days, we are still in day 14, even though he has paid 700,000. But he still has grace because it is not yet due. Therefore, we say current. And current, it seems not to have been impaired because it is still within the grace what? Period. And that is what that signifies. Now, how can we group this into past due? Remember, this grouping may be different from your own grouping as an organization. Some organization can group, let me show you what an organization can group it as. Some organization can group it as follows, beyond what we have done. Can do, extend it and say 90 days, 90 to 180 days. You can say 180 days to 270 days. You can say 270 days to 360 days, which approximately make a year, and above what? 360 days. Probably if a company have this distribution, probably by the time we do this, let me just arbitrarily get something. Let me say this is 67. This is 83. Probably at this point, it is 100% lost. That means there's nothing you can recover from this period upward. The debtor has even forgotten. When you even go and meet the debtor, you say, why are you harassing me? I don't have money. Do you get what I'm saying now? Therefore, that is that. But that is not the case in this case, which means nothing is cast on stone. It is a function of your internal credit policy and internal credit model. Now, let us interpret these ones. What is the grace period? I think I omitted that. Take note of the following. I'll put it there. Average credit period is 30 days. What does that mean? What it means is that from this invoice date, you have 30 days to pay. Anything after 30 days, it becomes past what? Due. Now, let's look at it. For Group A that bought on 1st of May, 2019 items worth 1 million naira. As at the reporting date, they see a balance of 120. Is it past due? Yes or no, and why?
No, it's past due. It's more than 30 days.
Yeah, why? Because if you check this, 30 days from 1st of March, you should have paid latest by 30th of March or 31st of March. The old 1 million, but you still have how much outstanding? 120. which means it's past due. The one of May 4, 30 days should like be 3rd of June.
Yes.
But you still have 100,000. Is it past due or not?
It's past due.
10th of September, 30 days to that should be like 9th of October. It still have 200,000 balance. Is it past due or not?
It's past due.
The one that bought on 26th of November is past due, Abi?
Yes.
The one that bought 10th of December and had 450,000 outstanding, is it past due?
It's not,
Yes,
it's not past due.
It's current.
No, no.
It's current.
Current.
First, let us answer. Is it past due?
No.
No, no.
No.
Okay. Now, since it's not past due, it means it still has grace period. 31st of December is still like 9 days away from when it falls due. Therefore, that is it. Now, when you don't know what is past due and current, you now group them according to the internal credit policy of the company of 30 days past due, within 31 and 60 days past due, within 61 and 90 days past due, and above what? 90 days past due. And the result of that, let me show you what I've modeled down, and we'll see it by the use of Excel. Now, what have I done? How do I know it's past due? You can see that this is showing 275 days.
Sorry, sir. This note. Sorry, sir.
Eh? Hello? I can't hear you, man. Hello? Okay, now, how do I get 275, 211, 82, 5, and 0?
Yeah, I said there's a note down, allowance for credit loss. I can't say.
Your network is bad. But I get what you are saying. You said there's this note that says allowance for credit loss as at the end of 2018 is 124. You see where it is relevant. They only gave us of our allowance last year. Why is it relevant? We are going to see that. Now, how do I get 275, 211, 82, 5, and 0? It's a simple analysis. Ask yourself. Look at this date. 1st of March, add 30 days to it. If you add 30 days to it, when is it due? It is due this date, Abi. Therefore, add 30 days to everything. Now you can see that this is due in 2020, which means it's not past due. That is why it is 0. It still has balance. But all these ones should have been paid before 31st of December. Now, the question then is, this is the year end. How many days have they fallen short? How many days have they been past due? 275 days. For the first one. For the second one, how many days? And this one is -9. And because I can't get minus past 2 days, I'll now use formula to say maximum of these past 2 days or is 0 to influence my formula. Therefore, when I drag it down, it will show me what is correct as is 0. Now, this is how I got it. These are due dates. And these are past due dates. That's how we got those dates. Yeah. Which means I can just link this for you so that I can see it. And on that basis, I'll now ask myself, 275 days, where does it fall in this matrix? It falls above 90 days, and that is 40%. Above 90 days, 40%. 11 days falls above 90 days, 40%. 82 days fall within 61 and 90 days, 10%. 5 days fall within 1 and 30 days, 2%. 0 is current, is 0%. That is it. Another way I can get my past due day instead of using this approach of clause is that if I'm building model, I rather use sophisticated formulas in Excel to do it. I can say date difference between my reporting date, which is a constant amount, and my invoice date, okay? Because I'm looking for the difference in days, I use column D column. And that will give me the whole period between invoice date and due date. But I'm aware that I have credit period of 30 days. I'll just subtract 30 days. What have I done? Okay, I didn't put space. Dated div, okay? No, I put double F, it's one F. One F. Let me check what is wrong in the formula. No. Okay. I put the cat before the us, I guess. Okay. It is date div, the invoice date, comma, the reporting date, comma, column. I said column. What do you call this? Your double apostrophe? D double apostrophe. That gives me the distance in days between invoice and reporting date. But because there's a credit period of 30 days, therefore, instead of writing 30, let me link it. I'll just put minus, instead of 30, I'll link it here because my credit days might change to 45 and I'm going to test it. Now, this is giving me number, but giving me date. I don't need date. I'll just put comma here to give me number, and it gave me that 75 straight. I can drag it down for all after locking the constant cell. And once I drag it down, it gives me the same thing. If I drag it down further, it will give me -9 because I've not limited it that anything negative should be limited to 0. I'll now come here to say maximum of what I get or is 0 if it's negative. And if I do that, I drag it back, it will give me 0, the same way I've done it here. And that is that. Now, that's another way you can get it. If you know how, I said, I promised you Excel formula and Excel dictionary. I'm going to send it to you, okay, to know some things you can do very smartly. Okay, now, if we change these dates, average days to 45, what will be the effect? The effect is that once I change this to 45, you can see that I give me that this 260, 169. Now, D is no longer past due because it still has a grace period. Okay, like if I come here and change this to 45, we'll get the same thing. Where's the 45? Yeah. You can see that I gave me the same thing. This is not past due because it's January now. You understand? And that's why you need to model so that it can be dynamic in nature. Now, that's how we got our grouping. Now, what then do we do as ECL? Is to multiply the carrying amount which are the exposure at default, yeah, with our loss rate, which we got from our grouping, and link it to this matrix, provision matrix. And your ECL is a product, is the product of your loss rate times your kind amount, which is your exposure at default. That's what gives us 48. And that gives me this. Therefore, I can sum up. And the sum is what gives me this. Therefore, this is our allowance in 2019. Whereas our allowance in 2018 was 124. Now, what can you say about this? That your allowance has reduced, thereby producing an impairment gain of how much? 9,600. Which means your condition this year has improved better than last year. Which means this year you have to reduce that allowance from 124,000 to 114,400 naira. Madam, does that tell you where you needed the opening balance now?
Sure.
Okay, I want to
ask a question.
Yes. What's your question? Your network is bad. Can you chat? Can you say your question on chat? Your network is very poor.
It will affect
your network. Sorry, I think I have to mute you. Your network is very poor. Please send a chat. Send your question via chat.
Count. All right.
Okay, please send your question via chat. Now, the entry to recognize impairment gain, which is a reversal of initially recognized impairment loss, is to debit your allowance for credit loss and credit your profit or loss by way of impairment gain, or what you call reversal of impairment losses. Does that provide clarity now? Does that provide clarity?
Yes, it's very clear, sir. It's very clear. Like this.
Now, loss rate, how do you get this loss rate? Is you must have data. What I'll try to do is that if I have time, I'll try to simulate data for a period of like 5 years. And I can use it to develop a model for you where you get these loss rates. Okay, but the fundamental of those loss rates is what we have discussed. And I've also shared some documents with you. Okay, how do I calculate loss rates for SME companies that do not have credit agreement with customers? Thank you very much. Now, if you don't have a credit agreement with customer, it means customer doesn't have more than few days because of processing, which means they don't have credit period, but they have processing period of 5 days. For example, if I buy, and it's not like I'm coming to your store to pay and collect the goods, but I have to collect it, you send me the invoice immediately and I must pay immediately. But that payment immediately means you have an allowance for 5 days processing time. Because in company, you don't just carry document today and process, they pay today and do also, it has a process, which means 5 days processing window is impliedly a credit period. And therefore, if that is the case, you input that 5 days here and it change the position. Do you get what I'm saying now? Otherwise, if it's just 1 day or is 0, you put 0 here and it change the position. And that is just it. The question is, your credit days, is it 0? That means it's cash and carry. Is it 5 processing day? Or is it 5 processing day plus the main 30 days credit period and etc.? That will address your issue. Madam, I believe I've addressed your issue. Please send a chat to confirm if I've answered your question.
Yes, you have answered, sir.
Thank you, ma'am. Any other question? Now I've shared some documents with you. Let me see if I can display those documents. And you can see different steps to obtaining your loss rates. Okay. Remember, one of those key factors is your grouping might be in days, and also the grouping can go by way of geographical distribution, can go by industry, can go by, which means it's not necessarily that your loss rate will just be for one group. The loss rate for the same number of days past due might vary from one group to another. Commercial customers or wholesaler will not be grouped with retail receivable. Geographical distribution might change it, and some other specific attributes, which means to arrive at it, you can still group them in different portfolios where you have different loss rates across the same past due periods. It's also key. You can, and that must be unique to you based on your credit terms and how you take credit decisions within the organization. Remember, you adjust for historical loss rate for forward-looking information. Can you see grouping here? Geography 1, geography 2, wholesaler different from retailer, even within wholesaler, asset different from network, and also of things. No one bucket fit all, because you are looking for homogeneous factors within your grouping. Homogeneous factor is what you use with respect to grouping. That is that. Any question before we wrap up? Okay, thank you very much. In the absence of no question, we'll call it a day. We'll see next week to forge ahead on the final aspect of financial instruments, where we'll be discussing issues of reclassification, the recognition, modifications to financial instruments, embedded derivatives, hedge accounting, and disclosures of financial instruments. Thank you very much, and God bless you all. Bye.
Thank you, sir.
Okay, bye-bye, sir.